it's a total cost issue, and it's about, are you getting value for money for what you're buying? So you can have very simple, very low cost solutions, but they not necessarily giving you the additional return, the additional insight, the additional control that you need to run your scheme. And that ultimately comes through in lower investment returns. So the trade-off is, are you going to be taking a low cost solution with a sort of lower potential for improving your funding ratio, or a higher upfront cost perhaps, but with more ability to put in place advanced strategies, better risk management, better control of your scheme. The second issue is the headline cost for fiduciary management doesn't reveal the full cost savings that can be delivered. So if you have for most fiduciary managers, they are in size significantly larger than any of the individual schemes that they're servicing. So they have buying capacity, which allows them to deliver external managers, hedging solutions in a more cost-effective way. There's also the ability to buy the technology to support the implementation. Is rarely cost-effective for anything but the very largest schemes. And if you have to pay a little bit to get access to that as part of a shared or a co-source solution, that's very much worthwhile. So it should be thought about as a total cost perspective rather than just a headline number. And it's really the onus is on the fiduciary manager to make clear where the costs, the savings, and the benefits for fiduciary management come from.
Yes, I think cost is an important factor, but by no means should it be the only criteria. And it's like appointing any advisor or any service. You don't always go for the lowest cost, even though it is a main driver. And I think what trustees usually do not take into account is all the costs involved in their investment solution. Current prices, there's no doubt standing charges for a consultant, all the exercises that are undertaken, the cost of trustees' time and effort in running a whole scheme, appointing managers, dismissing managers, apart from the actual costs that the fund managers charge. And sometimes those aren't very transparent, and I've often had people come to me and say, well, how do you get it? And it's not very difficult, but it just needs a bit of digging to actually see what the total cost is they're currently paying, and then compare it probably with an overall percentage cost that you might be paying a fiduciary manager. And if you take that into account, then, as has been said by my colleagues here, you've got the benefits of very, very large investments, and therefore fund managers what we're saying over backwards to be able to provide the services at a very economic cost. And so overall, all pension schemes should be able to benefit from the economics of scale in this instance.
Yeah, I can largely echo what's been said before me. It's about total cost. One thing I've noticed is that actually trustees often don't have a really clear picture about what their current total costs are. I've looked at annual accounts and reports, and it's impossible to determine the total cost because they're often hidden exactly in the fund prices, etc. So that's one challenge, creating a like-for-like comparison. Then the second thing is, even if that cost were to be higher for a fiduciary management solution, after you've included the legal costs that you're partially outsourcing, the investment consultancy costs that you're potentially partially outsourcing, not just the underlying managers, then where a fiduciary manager should already provide a benefit on a total cost basis because of the purchasing power that Guillaume was referring to. And we, in fact, have put our clients through an independent benchmarking, cost benchmarking exercise. It's quite well entrenched in the Dutch market. And our clients come out for a given strategy. Clearly, investing in hedge funds is going to be more expensive than passive equity. So a peer-to-peer, like-for-like comparison, our clients come out 20% lower cost than their peers. Why? The purchasing power. when you negotiate a mandate for 1 billion, you get a slightly different price than when you negotiate it for 50 million or 100 million. And then the final bit is, even if the costs were not lower for the compared to your current setup, it needs to be, there's 3 components that need to be considered. It's return, cost, so that gives you your return after costs, and that per unit of risk. It's that balance between risk and return that always should drive decision making. So go for the lowest cost provider. I wouldn't recommend doing it. I don't think fiduciary management is a pint of milk. It's not a commodity.
Okay.
I think it's really about the total value proposition, not the cost. And I think it's very easy for trustees to look at the cost figure and think, oh, that's a material number, but it's really understanding the true value I think they get for that number, and that comes through not just in terms of the investment return, but it also comes through the information they're getting, the level of comfort they're getting, the quality of the service, and I think those soft factors are important as well. And also the opportunity cost, which can be difficult to measure, but that should be thought about as well, and factored into the overall cost metric.